In the midst of a real estate slowdown, a potential 30% damage to home prices, and 7% mortgage rates, a brand new policy was just issued that would lower credit score standards and make it easier for a buyer to get accepted for a loan. 20 years of reliance on FICO scores are about to end. Some analysts worry that this comes at a time when deals are being cancelled, inventory is increasing, and a potential buyer might not be completely informed of what's about to happen. And so, this is the financial bridge, and let's discuss these confirmed changes that are set to take effect, how they will affect the overall housing market, and whether or not home values could face their second biggest drop since World War II. But before we get started, please make sure to give this video a thumbs up and might as well hit the subscribe and bell button if you'd like to see more of our content in the future. Now we won't waste any minutes, so let's begin. When it comes to making major life decisions like purchasing a home or car, or even establishing or repairing your credit score is by far the most important aspect to consider. Nonetheless, that appears to be winding down now. That's because Congress and major banks have taken matters into their own hands to design a whole new credit scoring algorithm to replace the current system after a recent research found that 53% of Americans are being turned down owing to weak credit. Give loans to people who don't have typical credit score and factor in novel elements that can assist or damage your application. Here is where things get fascinating from the perspective of the property market. But while the average credit score for a mortgage borrower is 725, 35% of Americans have a score of 680 or lower. Therefore, by increasing the number of people who are considered creditworthy to buy a home, the market is about to become significantly more accessible and affordable. What's more, this isn't just a suggestion from some obscure senator. It's actually going into effect. As such, it's critical that you have a thorough understanding of what's happening, how it will affect you, and the steps you can take now to make the most of it. As things stand right now, it all starts with something called an alternative credit score. There are 5 broad groups of borrowers to consider if you want to be the best approval odds and the best possible interest rate. The first and most important factor is your track record of making payments on time, which accounts for 35% of your score. The longer you have gone without missing a payment or being late, the higher your credit score will be. Utilization rate, 30%, has the second biggest impact on your total. The smaller your ratio of available credit to total credit usage, the better your chances of earning an upgrade. Third, the length of time you've had credit accounts for 15% of your score. Lenders would consider you a more reliable, seasoned borrower if you have a long history of maintaining your accounts in good standing. The fourth part of your credit score is based on the many credit accounts you've established. Lenders will be impressed if you can demonstrate that you have successfully paid off a variety of debt, including credit cards, vehicle loans, personal loans, and mortgages, and that you have done so in the past. The remaining 10% of your score is derived from the total number of credit checks that have been performed. Every time you apply for new credit, it will show up as a hard inquiry on your credit report, and the more of them you have, the lower your score will be. Although this has been the conventional wisdom for the past 2 decades, banks are beginning to realize that it may prevent otherwise qualified borrowers from securing a loan because they lack the information, resources, or motivation to go out and borrow money in order to establish or improve their credit. Because of this, they develop a whole new solution, FICO 10T and the Vantage Score, which will soon hit the shelves. There is a lot of new material worth examining, so let's speak about house prices before we get into the effects of a new credit scoring algorithm on the housing market. However, the annual growth in property values has shrunk to its fastest rate since records began being kept in 1987, according to a recent survey. According to this information, the rate of dwelling construction reached its high in the spring of 2022 and has been dropping ever since. However, nobody looks as gloomy about the real estate market as the finance sector. Professor Jeremy Siegel predicts a 10 to 15% drop in home prices over the next year, and he predicts that this decline will occur sooner rather than later because mortgage applications are at their lowest level since 1997. This would be the second largest housing decline since the end of World War II. However, according to Redfin's analysis of the market activity that month, 60% real estate transactions were abandoned and only 50% of bids were accepted. Unlike a year ago, when most houses entered a bidding war, there is no telling how long this trend will continue. They anticipate that the Federal Reserve will start cutting interest rates around the middle of 2023, at which point the housing market will begin to rebound. The fact that we're still much below pre-pandemic levels, despite having surpassed the lows of February 2022, suggests that neither sellers nor buyers are eager to give up the security of low-interest fixed-rate mortgages. It is vital to start on a positive one when discussing the impact of the new credit scoring methodology on the housing market, but all aspects must be covered. For one, credit scores provided by FICO do not reliably predict whether a borrower will really repay their debt. It is important to look at more than just a person's credit score when determining whether or not to rent to them. Other indicators of financial stability include their leveraged bank balance, whether or not they spend more than they earn, whether or not they've ever overdraft or bounced a check, and whether or not they paid their rent on time. Second, it widens the pool of people who can qualify for low-interest borrowing and hence puts that money away. If your credit score is below average, you may either need to pay a higher interest rate or be denied entirely. If they have ever paid late throughout their lives, they are detained significantly longer and charged extra for the same service. Thirdly, by considering a wider range of evidence, your credit score and principal will be far more precise. Naturally, you'd like this to have a positive impact on your grade. If you have a history of responsible financial behavior, you will likely have a much easier time getting the things you want. On the other hand, skeptics worry the new scores will dilute the usefulness of credit reports and scores by making millions of Americans appear safer than they actually are. If too many people suddenly acquire an increased credit score without a demonstrated track record, it might weaken the calculation and the credit scoring system as a whole. TransUnion found that borrowers with weak credit files were more likely to fail on loans, despite the fact that these borrowers made up a large percentage of the market. Moreover, according to FICO's estimates, almost a third of persons with no credit score have experienced a severe negative impact on their credit history, such as bankruptcy, making them riskier borrowers, but this is not always the case. It is possible that financial institutions are looking for a simpler means of issuing more loans because they simply want to make more money. Providing more credit alternatives may be helpful for the company, but that depends on people paying on time. It's too soon to say, but if 45 million individuals flood the housing market at once, it could be chaos. Most likely though, those who are right on the verge of being accepted will have the least trouble receiving a loan. However, it is not likely to have a major impact on the market. Therefore, having good credit is necessary for entry but not sufficient for approval. Banks are suspected of seeking fewer limitations so they can increase the number of loans they can issue and sell. Not much is going to change in the near future. But I tend to agree with the analysts that home values need to fall since they are too high in light of the recent increase in mortgage rates. Now, if you have any thoughts you'd like to share about what we just discussed in this video, then feel free to share them in the comment section below. But besides that, we thank you so much for watching. This is The Financial Bridge, and if you like this one, then please make sure to give this video a like and subscribe to keep up with our personal investment and financing content. Thanks again for watching, and we'll see you on our next video.